Hey everyone. Wanted to talk a little bit today about Amazon. So, almost everyone will be familiar with this company. It's one of the largest companies on the planet. It's one of the great successes of, Web 1.0, which transitioned to Web 2.0 and still going extremely well today. Um, it's a very interesting business from my perspective because at the moment it's a business transitioning essentially, and I'll get into that a little bit later. But it's an interesting business to look at. Almost everyone will be familiar with what they do and how they make their money and what they're most known for now. It's one of those great success stories and kind of ties everything in together. It's a little bit different than what I would usually look at. Like some of the companies that I've spoken about before are companies that have found themselves in some kind of operational niche which they're able to dominate for one reason or another, and over time are able to exact higher and higher prices for their service, which is a little bit different from Amazon's operating philosophy. Amazon's operating philosophy, and I think this term was coined by Nick Sleep originally. He wrote a number of, he was a fund manager and wrote a really great annual letter, and you can download all of them now. He had identified 2 or 3 modes of operations that a company could have that he thought would make the quality of that business more or less predictable. So he had 2 or 3 of these. The ones he's celebrated for rightly is the scale share. I forget the term. I think it's scale economy shared, if I'm right. Yeah, scaled economy shared. Now, the premise of this mental model, if you will, is that there are some companies who are able to exercise a cost advantage via scale, and then as they accrue those cost advantages, they return part of those cost savings or the entire cost savings onto the customer. The classic other examples of this would be a Costco in the United States or Geico. Probably most people are familiar with Geico's advantage of Geico and Costco's example. The Geico example is probably a little bit better. Geico's original innovation was that they would be able to sell insurance to government employees cheaper than other insurance companies by not using insurance agents who would charge a commission for selling an insurance policy. They initially sold all of their insurance via mail. And you can see how that's a virtuous cycle. If you don't have to pay a salesperson to originate an insurance policy, the 10 or 15% that you save on that, you can invest that into offering insurance at a lower price. And so lower prices attract greater and greater business over time. I think it's probably offering lower prices in the vast majority of transactions is a tremendous competitive advantage over time. And so Amazon, it wasn't their initial it wasn't their initial plan to do that. No doubt it was a long-term plan. But over time, with their basically enormous scale that they've been able to get to, and the cost advantages and the convenience factor that they've been able to introduce to e-commerce, they were basically able to take greater and greater share, derive greater and greater sales, and eventually branch out into other businesses with the same operating philosophy. So there's the Amazon e-commerce businesses, and the supporting services that go on top of the e-commerce, and then there's also AWS. And so AWS is Amazon Web Services. It's an infrastructure as a service provider, one of the cloud hyperscalers. And the essence of that business is kind of the same thing. They took an expensive fixed cost for web and software businesses and turned it into a relatively inexpensive variable cost. And so, via running their own data centers at scale, they were able to return the cloud computing to customers at a lower price than they could get it by doing themselves. But I'll jump into that later. So the initial founding philosophy of Bezos was centered around e-commerce and the sale of books. So the founding story is pretty well known. He was working at a very successful hedge fund called D. Shaw, and in the early 1990s decided to quit his job, moved to Seattle, close to where all the Microsoft engineering talent was, and start an internet business. All the interviews that he gives, he mentions how he saw the internet was growing at 1,000+% a year, and saw what an interesting opportunity that this could be. And so the original idea for the sale of books was that you could have a central inventory that could offer far more selection that any other individual bookstore could. And so that was a pretty prescient innovation to begin with. They started with books and then slowly, in concentric circles, as Peter Thiel would say, branched out into, virtually everything. And so if you read any of the early annual reports and the annual shareholder letters that Bezos does, which are fantastic, it's really fabulous. The first letter he wrote from 1997, which they reposted with every single other annual letter afterwards, basically goes into exactly what their operating philosophy is. It's long term. They're optimizing for free cash flow over time as opposed to earnings, and they're always looking to reinvest within their business, and then eventually that turned into be able to add cost savings to all of their customers. So the operating philosophy changed a little bit over time. If you read the letters, you'll see why. But so if the initial insight was that they could sell, any person could go onto the internet and have a greater selection of books, that greater selection would bring in customers. And then over time, they added a convenience element. So, they're very famous now for having sometimes same day or 1 or 2 hour shipping for certain products. And over time, they were able to add a convenience factor where they'd be able to get you any book you wanted in a couple of days, which was, again, another tremendous innovation. And then over time, as they went into video games, video and DVDs, general apparel, so on and so forth, and they started offering more and more products on the platform, the scale that brought allowed them to offer all these products at a cheaper price than you might get them anywhere else, extremely conveniently and with tremendous selection. So in about the 2005 annual letter, they basically solidified on those 3 points as their operating philosophy: greater selection, tremendous convenience, and cost savings, which is it's a tremendously powerful operating philosophy. you come across a lot of individual e-commerce businesses across the world today. And basically, almost none of them have been able to replicate exactly what Amazon has done, even though individual e-commerce businesses have been able to pick off, individual verticals. And so it bode very well. If you read the first, 4 or 5 annual letters, it illustrates the run up to the .com bust. So the stock, roughly went up 7 or 10 times between going public in 1997 and the 2001 top in the NASDAQ. And then there's the NASDAQ bubble pops. And the stock, I believe, goes from $106 to $6. So it's down 90+%. In a very short order. And so if you read the 2002 annual letter and the 2003, basically in 2002, they go into cost saving mode. They become cash flow positive. Most of the business metrics continue to do completely fine, even though the stock price has cratered. In 2003, 2004, 2005, they switch from survival mode into profitable growth mode again, and that takes them into the financial crisis and then the huge success that they've experienced since then. So it's all really interesting, and Bezos is pretty straightforward in exactly what he's optimizing for. He's quoting Benjamin Graham, Warren Buffett in his letters. They're fantastic. I'd recommend everybody read them. So in about 2002, 2003, the idea for Amazon Web Services is floated within the company. So from 2002 all the way to 2009, the company essentially faced no serious competition in infrastructure as a service, which was a huge head start for them as far as AWS was concerned. Later, Microsoft, later under Azure, Microsoft Azure, and Google Cloud or GCP would both come to join the party, and it's probably a 3-way oligopoly at the moment. Probably, whether or not Google can compete in cloud is probably anyone's guess right now. The gist with cloud is that it's been successful where it's been run by people who are adept at controlling costs. So while you might not think that an e-commerce business would be wouldn't be particularly related to cloud computing, actually in their DNA, having to continually introduce efficiencies and be very disciplined about costs actually bodes quite well for them in running a business where costs have to be kept low. The nature of the cloud business is that you need to be able to run these centers far more efficiently than everyone could run them individually. And so Microsoft has done that incredibly well. They've probably got a bit of a leg up because they've been serving the enterprise for probably 50 years now. And so obviously, that there's a lot of crossover and synergies with their existing client base. GCP, on the other hand, is, it's kind of staffed by like the most pampered millennials anyone can think of. There was a unionization effort led at the beginning of 2021 by a person who was employed full-time by Google to write code for a internal software program for booking out conference rooms. So there's a lot of questions about how disciplined they can be on costs, and of course they don't have a natural segue into the enterprise that a Microsoft would have. even though they've probably got at this point quite a good leg into the SMB market. So that's really, yet all to be concerned. So anyways, they had this, tremendous leg up in web services running into 2010, and then they faced increasing competition since then from the other large hyperscalers. The other things probably to note, apart from AWS, in terms of business segments, obviously they began life as a direct retailer of books. They then started directly selling other products, and then eventually they let third-party sellers onto the platform. Now the third-party business is much better than being a direct retailer yourself. So for the purposes going forward, I'll refer to the third-party sellers just as third-party, and then for those products sold directly by Amazon, it's one party. So the third-party business is traditionally a great business. That's kind of what Alibaba does. Certainly, what an eBay does. And the great thing about that is that, and leaving fulfillment aside, you're not you're not holding this inventory. You're simply allowing a marketplace for somebody to sell a product, and you charge a markup for that. Now, obviously, as Amazon's scale has gotten greater than anything else in terms of e-commerce, especially in the United States, the premium they can demand for sellers to sell on the platform just becomes higher. Any seller on the internet is going to find one particular outlet for their sales to be higher than all others, and so for a lot of people, that's Amazon. People have built entire businesses on it. There have even been public companies that have been roll-ups of of people selling on Amazon. And so obviously, as you continue to aggregate, just enormous demand from the public, you can charge greater and greater fees as you have greater and greater lock-in on your merchants, on your third-party merchants. And that's exactly what they've done this year. They've raised fees on them. Now, certainly from the post-dot-com bubble and then the post great financial crisis in 2008 era, they've also developed probably the most extensive logistics and last mile delivery network ever. Essentially what they've done is they built a railway in their fulfillment network. And there have been incredibly large companies built on logistics and fulfillment before, like UPS, FedEx. And so traditionally those businesses, in terms of logistics and fulfillment, they may have, in terms of individual parcels being delivered to homes, those companies may have commanded as much as 30-35% market share at one point. And basically in the post 2008 era, Amazon has every year been delivering greater and greater market share. And that part is very interesting because it's another way that they're going to dominate the e-commerce space. The fulfillment, and especially the speed and convenience of the fulfillment, is a huge moat in and of itself. And over time, it's probably a moat that people would pay more and more for. So people will pay a tremendous amount of money to save time and energy. And if you're able to deliver something at quicker and quicker rates, people will naturally want to pay more and more for that. Now, when you think about the competition that comes from other sectors in terms of e-commerce, you can think about Shopify and their operating philosophy of arming the rebels. They want to enable 1,000 merchants to use their software to sell their products online. And that's a decentralized approach as contrasted with a centralized approach that an Amazon would have. The problem with a lot of that is simply the logistics and the fulfillment. So, at the moment, Shopify is trying to build out a fulfillment network, and essentially in lieu of having already built one over the 20 years, it's going to be incredibly difficult. And so one of the things that Amazon has rolled out recently is extending their logistics network to individual merchants on the internet. So you've probably even seen this on a couple of websites where you can buy with Prime. And so Prime is Amazon's subscription service. Basically, it's a annual fee, and in that annual fee, they throw in a whole bunch of different stuff. But it's most well known for a free delivery. So you pay this annual fee, and you get free delivery. It's a double lock-in. So when you pay a membership fee, you feel compelled to take advantage of it. And so the average Prime user spends double or triple what a non-Prime user would use. And then, over time, as you become more accustomed to ordering things online and you accrue these enormous cost savings, you continue to order more and more. On the other hand, there's probably like some people who get the Prime membership for whatever reason and then don't use it. And then that's just, 100% pure profit on the subscription side. The logistics network is an enormous moat and a killer to almost everyone else who wants to compete in the space. So generally in e-commerce, two modalities have proven to be successful. The first modality would be the Amazon model, which is tremendous selection, an enormous selection of products at a low price, delivered extremely conveniently. So it's all cheaper, faster, more. And that's a way to appeal to the lowest common denominator and the largest section of the population. If you could maintain a dominance in each of those three categories, it's very difficult for, first of all, incumbents to even, for newer players to even enter that space, because what they are facing is such an enormous wall of competition. If you think about what Amazon has built since it went public in 1997, it's hundreds of billions in capex. It's 1.5 million employees. It's we can deliver this product to you within 1 hour in certain cases. And so that whole business model, incredibly difficult to shoot holes in that, so long as you can continue discipline in those three areas. The second modality, which has been, and I would say successful in question marks, because some of these businesses remain successful for short periods of time and then are systematically overtaken by newer challenges, would be something like a Redbubble, perhaps. Etsy would be a great example, is where you can have these small niches within e-commerce that go very, very deep on a particular retail vertical. And so, you might be able to find very unique things within a vertical, and then you're going to be willing to pay a premium on top of that for that product, for that selection. So if Amazon's going over everything, they go incredibly wide, but perhaps only a few inches deep, and then there are a few players in certain verticals which go, they're what they're looking at is an inch wide but a mile deep. The problem with those companies, and if you've ever ordered anything off a Redbubble, for instance, or if you've ever ordered something from Etsy, it's generally very expensive, and the logistics and fulfillment is not great. those companies can be good for a while, and so some of these companies have a long public tenure. In the example of an Etsy, they've been successful partially as a roll-up. So they started with, you know, a good initial product, and then they've been able, you know, to continue to buy up these players. And so, you know, we're going to see whether that's successful or not. There've certainly been very large failures. The real problem is, even if you come to dominate a particular vertical, the barriers to entry are not particularly high. And because the service level naturally has to be lower because you're only focusing on a particular vertical, you know, nothing's really going to stop your incumbents from offering something is similar if they can get both sides of their marketplace working. And so I'd say that's a much less interesting thing to invest in, just because it's very difficult to predict who will be a winner at any particular time, and any you know, winner at any particular time, that's probably not the same person who'll be the winner 5 or 10 years from now. Very few of these businesses have shown very attractive economics, in the fact that typically the cost of customer acquisition is very high, incredibly high. A lot of them are reliant on Google and gaming SEO for results. And so, you know, even now, one of the big problems for them is that while some of them have invested in their logistics and fulfillment network within the continental United States and perhaps even parts of Europe, it can be nothing like Amazon. It won't be anything like Amazon. So Amazon is already delivering, you know, all these packages, deliveries, groceries. They'll be going into medicine to all these homes via their existing network, and they'll be able to you know, offer that to other third-party merchants. And if you think about it, the marginal cost of just adding another parcel to a delivery van at a certain scale, it's quite incremental. So they've got the traditional first-party e-commerce business, which is now everything. One of the things to mention about their first-party business is that it's quite controversial. So as it has got larger and larger, it's been accused more often of using its own back-end analytics and data to essentially identify what sells best on their platform as far as third-party sellers go, and then they go and copy the product. Now, if you've ever bought any Amazon branded products, they're like an order of magnitude lower than anything else that's selling on the platform, because Amazon's able to purchase those products in such like vast quantities. Very Costco-like when they do that. The problem with that is that there's an inherent conflict of interest, even if they're not doing what they're being accused of. And it seems quite shady if they are. But it also fits in with their operating philosophy, which would be, you know, their customers, the people who come first. Our customers in the first instance are people who purchase products off the website. And perhaps they see their third-party sales, even though they're customers as well. Perhaps they're not the, you know, ultimate derivation of value. So that's controversial. It's capturing the ire of the regulators. The regulators don't like to, you know, it's very politically insensitive to have small ma and pa single person operators being, you know, essentially price gouged by the platform that they're selling on. That doesn't spin well, and Bezos has been dragged before Congress on a number of times to address that issue. The first party business is also not a great business. You know, the online stores is essentially, you know, break even, perhaps 1 or 2% margin business, even though they do a tremendous amount of sales. And so at the moment, they've signaled that they will be exiting parts of their first party business, which is probably quite a decent thing. If you end up making no money on the largest segment by revenue, which it traditionally has been, the only real explanation you can have for that is that the low-cost first-party sales are a way to continue to draw, enormous traffic to the site. And that's controversial. So a lot of people see the first-party business as a loss leader, and it's a way to attract third-party merchants. Selling third-party merchants is much more profitable than selling your own products at very low cost. And you can charge the third-party sellers all sorts of fees, and with enough scale, you get enough lock-in from the merchants, and you can begin to flex pricing power on them, which is exactly what they've done in the last 6 months, as the operating environment has forced them to do so. So they've decided to exit parts of their first-party business. And so the real question will be, what continues to lock people in? And so if you think back to the operating philosophy, enormous selection with great convenience at a very low price, it certainly does ask a question about the low price part of that. Naturally, if you're able to draw a large number of third-party sellers to your platform and continue to draw them to the platform, that will result in competition and lower pressure on products over time, no doubt about it. But having the third-party sellers on there is, that's one part of the marketplace. The other part is the demand side of the equation. So being able to draw many, many people into the site. And so there's a very good argument for the fact that, there's, as in terms of Prime subscribers, it's in the hundreds of millions. So there's some crazy statistic where it was like 72% of millennials are Prime subscribers. So you've got a very large portion of the, high spending portion of the population locked into the ecosystem already. And in terms of convenience and delivery, no one else is even going to come anywhere close outside of Amazon's fulfillment network. So it'll be very interesting to see whether they're able to transition away from this first-party business. And if they're able to do so, the 100 billion plus, the hundreds of billions of first-party sales would naturally transition to third-party sales. Now, if the third-party sales are some order of magnitude more expensive than the first-party sales, it's probably likely that not 100% of first-party sales would move over to third-party merchants, but it doesn't really matter because every dollar that moves over is incremental. And so even, if this were to go to zero, which is probably not likely, and then, even like 25% of the first party sales went to third party, it's a big delta it's a big win for the company. So that's part of the transition, is that the commerce, the crummy first party business might be transitioning into more third party and higher margin products. So we've talked a little bit about the e-commerce side of the equation and the cloud services part of the equation. The other part, which is incredibly interesting, is the advertising reporting segment. So I'm led to believe that an increasing number of people begin shopping online on Amazon. So it's a form of discovery. It's not It's not as DTC as like a Facebook would do. A Facebook innovation would be you weren't even thinking about buying something, but because they've got all this information on you, they can serve you an ad, which would be highly predictive of something you'd be interested in. So that's like taking you from a non-buying state to a buying state. Naturally, if you go onto Amazon, there's a kernel of thought in your mind that you might buy something, or you'd be interested in buying something, or that you're interested in seeing the price of something. And so many people begin their online shopping on Amazon. Now, the other development, which has been very positive for them, as opposed to a Facebook or Meta platforms, is that with all these privacy changes coming across the various mobile platforms, the effectiveness of targeted advertising has become far less. And so in a world where you're not able to easily scrape third-party data off an operating system and hence be able to serve somebody an ad that would be highly targeted to their needs, having first-party data on your customers is incredibly powerful. So in terms of Amazon, probably almost nobody has any more first-party data than Amazon. They're able to see what you're searching for in a high-intent environment. So if you've searched tennis shoes, you know, they're going to be able to grab that information and serve you ads, perhaps on, the Amazon streaming platforms or, directly on the e-commerce site itself. They'll be able to serve you ads for something that you have a high intent for. And so with that treasure trove of first-party data, advertisers will be incredibly interested in advertising on that platform, especially where their other direct-to-consumer platforms have been performing poorly. The advertising business, as far as digital advertising goes, a phenomenal business. It's super high margin. So long as you provide effective tools for advertisers, and there's a high demand for those ads, it's virtually all incremental to the bottom line. That's why Facebook and Google have such phenomenal margins at scale. So that's advertising. Advertising, another high margin, profitable, that's a business that's profitable essentially from day one. And they're getting enormous sales. The advertising business was almost nothing to speak of 5 or 10 years ago. And now, I think they're on a sort of 11 billion a quarter run rate at very high margins. So, another phenomenal part of the business. Probably something else to talk about is that this is a company that has a DNA for innovation, a legitimate DNA for innovation. The other large tech players have probably been quite effective at either copying or buying competitors. So in the case of Meta platforms, Zuckerberg obviously was central in developing the Facebook Blue product, but since then has not really created, any new standalone product. They acquired WhatsApp, they acquired Instagram, they acquired Oculus. Perhaps you could say Messenger was a product that they created. Whether or not you want to call it standalone or not is, that's personal preference, I suppose. But their main growth vectors outside of their core business were all acquired. Google is similar in that respect. They've been fabulous on the acquisition side. Obviously, the acquisition of Android and YouTube was transformative. And the Google Advertising Network as well, I believe that was an acquisition too. So they've been very effective there. They have obviously develop product like, Google Maps, Gmail, etc. Those kind of products were Web 1.1 innovations that they either copied from somebody else or acquired and then brought in-house. And Microsoft, since the development of the initial operating system, have stolen or acquired all of their other products. You go down the line, PowerPoint, Word, Excel, these are all copycats. The latest innovation, which would be Teams, that was a ripoff of Slack. And even their cloud service, their cloud business now, it's obvious ripoff of AWS. Amazon itself has showed incredible ability to launch businesses in apparently unrelated vectors. So you can do the e-commerce thing, and obviously that's developed in iterative circles, books to basically everything else, and then layering third-party and advertising services on top. But AWS, there's no natural progression from selling books on the internet to offering cloud computing as a service. So they have this very unique DNA, if you will, that allows them to be very, very effective and come up with legitimate moonshots that they don't need to acquire, even though they will invest significant resources in a lot of these ideas. So if you look at their latest annual report, their kind of other bets segment is growing 100%, 130% year on year. And so nobody really has a really good idea what's going on inside of there, and they don't tell people. They didn't advertise AWS to investors or the general public until about 2009, even though it was conceived of and brought to life in 2002, 2003. And so there's probably a very decent chance that they come up with another really interesting business over time. There's some likelihood that that's going to happen. And there's a few really interesting businesses they've come up with that the public are aware of. Like they've got an autonomous vehicle business. They've got they patented this just walk out tech, which allows you to just walk into a store and then leave with whatever goods you pick up and charge it directly to your card. And so some of those businesses are incredibly interesting, could be extremely large addressable markets. And in the case of the software products like the Just Walk Out tech, enormous licensing fees with fabulous margins. So the reason why I find this interesting, aside from the general innovation and the enormous success and the very interesting culture the place has, is that this is a business which is transitioning from sort of on an aggregate level from a break even or even a very low margin, high growth business to a lower growth, potentially lower growth as a whole for some period of time, business, but at much more attractive margins. So I read this great piece about Amazon's revenue mix this morning. There's a really great infographic here. So basically what this is showing you is a contrast between 2019, so financial year 2019, and the latest quarter in 2022 of the revenue makeup at Amazon. So you can see here there's broadly orangey brown. It's an orangey brown segment, which indicates businesses that are either break even or loss making, and you've got the blue parts which show profitable reporting segments. So on one hand of this, you've got the unprofitable parts, which would be the online stores, subscriptions, and the other bets. Other bets are a small part of revenue, but obviously, lose money. The online stores are, roughly break even, slightly, loss making. And the subscriptions are naturally loss making, at least for the time being. And on the positive side of the equation, you have AWS ads and third-party services. So at the moment, AWS essentially contributes, more than 100% of the operating income. So with the headwinds it's facing in its core business at the moment, I'll get to that in a little bit. AWS is essentially carrying the entire business. Now, traditionally, AWS has had an enormous, has had a tremendous growth trajectory over time. Its problem is that it was just such a smaller segment of the revenue than was the traditional e-commerce business. And that's doubly true for ads and third-party services. But you can see with the exit from the first-party business, and you can see with AWS's continued growth. So the last quarter it reported, plus 30% growth, which is incredible for a business that's going to be, do 71 billion, 72 billion in revenue this year. It's still growing at just astronomical rates. Absolutely phenomenal. And so even in the last 3 years, we've kind of hit this almost inflection point where the profitable high margin businesses are becoming a much larger piece of the pie. So, AWS, 3 years ago, it was 12.5%. It's now almost 16.5%. Third-party services is up, getting to 22.5% as opposed to 19%. And ads, which is phenomenal, probably maybe even better margin business than AWS. That's growing incredibly fast. That's gone from 4.5% to almost 7.5%. Now, sorry, as I said, with the exit of the first-party business, the online stores segment will probably decelerate. So in the last year, they've already seen not even deceleration, declining revenue in the online stores. And a reason for that is they are lapping incredibly difficult comps. So during the COVID pandemic, obviously that was an enormous demand pull forward for Amazon in terms of its e-commerce business, because you're stuck at home. You don't want to go to a store and get COVID. You're going to order on Amazon, get it delivered extremely quickly too. And so you had enormous demand pull forward. Now we're lapping that. And we're lapping it into an environment where consumer sentiment is much lower than it's been in a very long time. Inflation's picked up and the consumer balance sheet is deteriorating a little bit. So it's probably quite likely that business declines modestly, and depending on how aggressively they depart some of their first-party businesses, that could become much smaller, much quicker than people think. And the corollary of that is that the first-party business, some portion of it will transition to the third-party merchants. Again, the third-party merchants are a profitable part of the business, certainly much better than the online stores. And you're able to layer more and more product services onto the third party, like advertising over time. So that's very positive. On the AWS side, that's traditionally a business that's shown 30% operating margins, which is phenomenal, especially when you have a business growing 30+% a year. And so the other important part that would say, as the declining, as the reporting segments which are not profitable or break even, while they probably decline quite quickly, the extremely profitable parts of the business, such as AWS, are continuing to grow at kind of breakneck pace. And that decline in the unprofitable segments will actually aid in the growth of the profitable third-party segments. And so one of the great predictors of stock performance over time is what kind of direction are the gross margins going. You'll see tremendous stock performance for companies where gross margins increase over time, show operating leverage. You know, the valuation metrics for increasing gross margins they're just more favorable. And so you've got this inflection point where we're going to move more towards these profitable segments. And as AWS especially becomes a significantly larger portion of this business, if you grow at 20+% a year for the next decade, it will be virtually the entire business. That's just maths. And there's probably, you know, some very good chance that it grows at healthy rates. I'm not saying 20%, certainly not saying the current growth rate of 30, 40% a year will continue either. But there's a very good chance that it grows at very healthy rates for a very long time. It's very difficult to kind of ascertain the effective penetration of the cloud services. But, you know, probably second, third inning, something like that. So that's really interesting too. Now, obviously, as the profitability of this company, certainly on a post-tax basis, becomes a lot more interesting, the likelihood that the cash that they'll be generating so much cash that not all of it can be reinvested into the existing business. And that's where you might see things like a significant buyback program over time. And so for the first time in their history, I think they've authorized a $10 billion buyback program. Obviously, in the context of Amazon, that's a drop in the bucket. This is a company with a $1.5 trillion market cap. But it's something they've never done before, and it's, you know, it's a positive sign in their capital allocation. There will no doubt be a time where they are tremendously profitable, and because they are making simply so much money that it simply cannot be effectively reinvested. That at such a scale that's probably true. And so those things are all positive for shareholders. Capital being returned to shareholders is quite a good thing. And, you know, the valuation metrics will look significantly better over time if there's a delta, a large delta in the profitability of the company. Like, I think at the moment it's like a 50 or 60 PE, but that PE is kind of obscured by, you know, you can see still over 50% of the company's reporting segments are negative or, you know, break even in terms of their profitability. So that's really interesting too. Probably over time there will be more and more pressure for this company to spin out AWS. And there are some good reasons for that. AWS in the coming years, I'm led to believe that there is a little bit of crossover at the moment in terms of how the business operates and its synergies with other departments, but this is an unrelated business from everything they're trying to do on the consumer side. And there are conflicts of interest emerging here, which are probably a reason why the company is not growing as fast as Microsoft Azure. So with the consumer side of the business, branching out into everything from, you know, content creation to medicine. Obviously, there's, you know, they've moved into physical stores as well. That's an endeavor that will bump heads with a lot of existing AWS clients. And so the best example of this would be Netflix. Netflix was a company that migrated their entire servers over to AWS, which is, fabulous. It shows what a great service that AWS provides. However, on the other hand, Amazon spent, I think, $13 billion on original content last year, directly competing with a large customer in AWS. And so this is not dissimilar from the reservations people have with the first-party business. There are questions about the integrity of their service. Now, there are large segments of the of the economy that are geared towards retail and are probably direct competitors. So, your Walmarts, Costco, Target, on and on down the line. And even if these companies are not e-commerce first, they will certainly need more computing over time as more services are offered on the cloud. And so those companies are extremely large, will have large budgets for these kinds of things, and they're not going to be particularly interested in taking advantage of a service run by their direct competitor. And because of these kind of controversies, they look a lot less partial. And that brings, up another point, which is that in the early days of AWS, some of the great first commercial successes were because, they were able to sign up the defense departments as clients. And so, that adoption by the government, it's obviously a great feather to have in your cap. They're large contracts, and those kind of things attract more customers. I've seen it in our own line of business, where you can have big blue ticket customers. They talk, they tell other people. You're able to boast that you're, supplying the government, and it's a very positive thing for the business. And it was no doubt a very good thing for the business going as it started. Obviously, these contentious things with, warehouses unionizing, people complaining that it's working in an Amazon warehouse is like working in a Chinese sweatshop. These things they become quite divisive, and on both sides of politics. And so the likelihood that you garner the ire of a administration or a number of Congress people is high. And the best example was when AWS lost some of the government contracts in the Trump administration, and that was probably idiosyncratic because Bezos made the mistake of openly criticizing Trump. Trump is the kind of person who does not take well to public criticism, and so that was an example of where the company had become publicly divisive and administration decided to funnel business to a direct competitor. Many of these problems and their market opportunity would be ameliorated by AWS becoming a standalone entity. They would win more business. They would be seen as more legitimate. They would be able to shake the public's perception of them as, a sweatshop operator, et cetera, et cetera. And they're losing business because of this at the moment, even though they are running, the best platform. And so the AWS spin, which gets talked to death on Twitter, people have been joking about it, demanding it, crying about it for years now, would probably be an enormous value accretive event. Even in the current environment, AWS would demand such a premium in the market. It's kind of, probably even quite difficult. But as Buffett says, you know, if you try to hold a rock concert and a ballet concert at the same time, you're going to have pretty confused attendees. So, you know, spinning these out, you'd probably have a tremendous premium for AWS. You'd have a better business in terms of its prospects going forward. And you'd have more alignment in various parts of the business. So the traditional consumer-facing Amazon business could continue to, you know, try to gobble up the entire GDP of the United States in every consumer vertical. And you can have AWS, you know, operating perfectly fine on its own as well. And, you know, I'm sure, you know, there'll be all kinds of arrangements about Amazon being able to continue to run their workflows through it at a, you know, appropriate rate, and, you know, so on and so forth. Probably the operating margins would look a lot better. Most people suspect that Amazon's dumping its own internal cloud costs into AWS, which would naturally suppress their margins. And so that would be, you know, a really interesting thing as well. In terms of valuation, this gentleman made a very good run at a sum of the parts valuation. I don't put a lot of weight behind sum of the parts valuations. They're like an interesting exercise to do, and it's a good way to orientate yourself towards what's going on in various businesses. But I wouldn't kind of, it's not something to hang your hat on. Any business is going to be valued on the money it can produce and its margin profile over time. And just because you know, one part is fabulous and 6 parts are pretty average, doesn't really mean much. So, you know, I don't like, you know, people have a few different ideas about fair value. It's probably somewhere between $3,000 and $4,000. That was pre-split, so, you know, somewhere between 150 and 200. It's probably fair value somewhere in there. The important thing to contrast it against a lot of the other FANGs, which is that this company has a lot of embedded growth. There was a really good, image, perhaps not in this report, which had, well, this is the AWS revenue growth. There's also a picture where they have the AWS commitments. So commitments to spend on AWS superimposed against this, and it's, you know, 3 or 4 times revenue. So you've got these contracts with commitments to spend for many years out. So it's very, the AWS revenue growth will be very predictable, but probably almost certainly a headwind, even for AWS, is the current environment that we find ourselves in. So the high fuel costs that we're experiencing right now are just a tremendous drag on the performance of the business. So, you know, the company probably spent anywhere from like 50 to 100 billion on increased fulfillment costs this year. And it's just devastating to the rest of the business. That's a huge headwind and a real unknown, depending on how high energy prices stay. It's anyone's guess as to whether this is permanent, not permanent, how long it lasts for. But you hope that oil prices would normalize over time. The other headwind that the business is facing at the moment is just like dealing with the crazy employment and logistics build out that they did during COVID. So just like Toby Lutke said at Shopify, many of these companies were expecting a significant step change in consumer behavior, which instead of being a permanent step change was a temporary step change that reverted to trend. So you can see the number of employees. I think this gentleman has it down on his the employee growth. So this is a business that, in 2019 went from 800,000 employees to 1.6 million employees as they built out their fulfillment capabilities, mostly. And that's a staggering number. A company with over 1.6 million employees. And so there's a few interesting parts about, how many employees they've got. Obviously, the bulk are these warehouse workers. And there's tremendous turnover in the warehouse workers. Part of it is seasonal, because obviously the fourth quarter or the Christmas quarter has a lot more buying than the other quarters for retail, and so you have to bring in seasonal workers to meet that demand. But the working conditions are really tough. That's pretty clear. And so you have a lot of people leave, especially over time, as the requirements for their performance are stepped up over time. It's not really very possible to be a long-term warehouse worker, because you're on this treadmill of sort of exponentially increasing performance standards over time. Now, so you have this tremendous turnover, and you've got all these employees. Part of them are seasonal. Now, they've just simply employed too many people. You can see the step change is really significant. An increase of employees that may have taken them 3 or 4 years pre-COVID took place in 2 years. And so one of the positive things is that they have been dealing with this, which is they'll be able to grow into some of the logistics infrastructure, even though they have been subletting millions of square feet of commercial real estate space. So they'll be able to grow into it. So there's been CapEx that's been spent that won't necessarily need to be spent at the same pace in the future. And because they have such a high turnover of staff, they've been able to reduce their headcount by almost 100,000 people. So this 1.608 million employees at the end of 2021, as of the second quarter in 2022, is now 1.5 million, which is certainly a good thing for shareholders, a really good thing for shareholders, if they're able to get control of these costs, especially as labor costs are going up. More and more of the warehouses facilities are probably going to unionize. Now, over time, with their investments in robotics and automation, you'd expect for this to at least not grow as fast, especially once they come to some level of saturation in the market. So look, that's pretty much it. This is an interesting business at an interesting inflection point. It's going from a traditionally low margin business to potentially a much higher margin business, which is traditionally a very good thing for stocks. And with AWS and advertising and third-party services continuing to grow at pretty good rates, there's likely very good growth rates at better margins for them going forward. And the capital allocation looks much better going forward, certainly, than it has over the last 2 years. CapEx might be ameliorated. Headcount is coming down, which is positive. And they're beginning to return capital to shareholders. So an interesting company. If you like this, leave me a comment. Let me know what you think. Thanks.